I've been Reppond. Welcome to my YouTube channel. Today is the 8th of October, 2025. Okay, I'm going to give you an analysis of the market for this past week. We'll begin with the dashboards. Quite unusual. Here we have the six that I measure, 4 U.S. markets, Dow, S&P, Russell 2000, and NASDAQ, and 2 foreign markets, the emerging market, ETF, EEM, and the developed market, EFA. Again, it's a basket of companies from different countries. And then the long-term government bond, ETF, TLT. What's interesting, why this catches my attention so much, the yellow box is this past week. All 7 are positive. The year-to-date in the red box, all 7 are positive. And all are above all 4 moving averages, the 20, 50, 100, and 200-day moving averages. 28 out of 28. Wow. And I think this is the 3rd week in a row that we have had all 28 positive. The sectors, this is the 11 major sectors, and these are listed as an ETF on the far left side. You can see the name, and then the description is in the second column. Yellow box, what happened last week, and then the red box, what happened year to date for the sectors. And then to the far right, where are they above or below their moving average, green dot or red dot. Yellow box, you can see there were 3 that were below their moving average, and that means 8 were above. On the red box, all were positive, above their moving average, except for consumer staples, which was below has been down for the past year to date. It was interesting about consumer staples. In our sector rotation strategy, it picks the ones that are the best performers, and it continued to pick consumer staples, the best performer in the first quarter. And it gave us an outstanding performance when the market was going down. And a fair amount of that was attributed to consumer staples. Anyway, so here we have 37 green dots out of 44 compared to 34 the previous week. This is the chart of the S&P 500, a line chart. It's a weekly chart. So 1 move equals 1 week. The bottom, when you look to the right, the last inch or two, you see that drop that happened in March, and it went down to, I think, April 7th, where it bottomed out, and then it just took off from that bottom, which that's not uncommon to happen. And then, and here it is, it's gone up and up, and it continues to go up. So we're just continue to keep hitting new highs, and it seems like, has seemed like to a lot of people, that the market is overbought. It's overbought. True, it's overbought. That doesn't mean it's going to go down. It will go up until it decides not to, but right now it's continuing its upward trend. When I put that over on a candlestick chart, same thing, except you get to see the weeks where it goes down, which is the red candle, and then the clear ones is usually those are up weeks. And from, well, again, this last few months, it just keeps on rolling up. Here is a candlestick chart for just 2025. It just magnifies that last part. And pretty interesting. It just keeps going up. And above the moving average, and with an arrow directionally, definitely going up. So it seems to have strength. It's a momentum market, and I'll show you where the This shows the S&P 500 compared to the NASDAQ 100. So the NASDAQ 100 has outperformed the S&P to the extent that it goes up. And it has gone up and down, but initially it went up a lot, and that was attributed to the NASDAQ 100. This breaks apart the growth side of the market to the value side. And again, this has gone up and down, but over time, it has more favored the growth side of the market. So when it goes up, that's growth. When it goes down, that favors value. The S&P 500, when compared to the small cap index, when it goes up, favors the S&P. When it goes down, favors the Russell 2000 small cap index. Small cap has been in favor for the last couple of months, a lot, and is still in favor. And I drew a black arrow at the very end so you could see the direction. And to the extent that it goes down, that's Russell 2000. The dollar is weak. The black arrow shows how much it has weakened. It's down about 10% from the beginning of the year, and it's slightly above its moving average, but it's weak, and this last week was also down. What that means is when you buy, if the dollar is weak and you're buying foreign goods or services, that you are paying a premium for them, and then when people are buying in the U.S., if foreign money is buying U.S. goods and services, they are getting it at a discount. I compare the U.S. market, SPY, the S&P 500, to EWY, which is the South Korean market. The reason is because it's so smooth. It's either going up or it's down, but it's fairly smooth either way, as opposed to jumping around. So it's a good proxy for looking at foreign markets, in my opinion. This is a five-year chart. When you see the last year or so, I put a black arrow to show the direction. It is going down, including going down this past week, meaning that in this case, South Korea is that much stronger than the U.S. market, and you could say a lot of other foreign countries are as well. Now, I'm not talking about the buying power of the currency. I'm talking about the stock market in those countries. There was a little bit of negative move, not enough to move some of the charts we looked at earlier, but a little bit this last week, and that caused the volatility index to go up a little bit. I put a line up there around 24 so you can see where my number is of where I think risk starts to enter the market and how far we are away from that. We're not there yet, but if it moves up, that'll be something we'll be looking at. TLT, the long-term government bond, this is a 6-year chart. I put the black arrow to just show the fact that in what is this, 3 years, almost 3 years, it's gone nowhere. It's gone up and down, but nowhere. So the returns on bonds, bonds are just terrible. But they are put in a lot of portfolios because the business schools teach it. They've been teaching it since 1952. They completely believe in it. But this last week, you might have read this, Morgan Stanley decided their traditional portfolios are going to include 20% precious metals, some combination of gold and silver, maybe even platinum and palladium, I'm not sure, but some combination in there in those portfolios. Now, they're not, I'm quite sure, they're not putting in the physical metal. They are putting in an ETF probably. But it's interesting, they have, they cut their bond allocation in half. That tells you how terrible bonds are and how good precious metals are and how good they expect them to be going forward. That was, I think, a courageous move on their part to do that. Okay, gold. We've been talking about precious metals. So the long-term direction, meaning 3 years, definitely up. I put a red arrow at the end of that to show for the last, what is this, month or so, how much it has been going up. It just hyperbolic. Silver, look at that. Silver is going to the moon, it looks like. It's not, but every day when I look at it, it's like, okay, it's up again. And I put a black arrow to show the short term. This is about a 6-7 month period of time, that the short term degree to which it has just blown it away. And look how far it is above the moving average. Next slide, Bitcoin. Bitcoin had a positive week. You could see the little move up at the very upper right, and the overall trajectory is in an upward direction. Not as dramatic as gold and silver, but it is positive and moving up. This shows the price of gold as of Friday, $3,885, pushing up toward 4,000. A lot of people are talking about 4,000. Some are talking about 5,000 or beyond. Silver, 47.92. It actually went up over 48, but then settled back at 47.92. Today, as of this recording, it's well above 48. The gold-silver ratio is 81 to 1. What that means is it takes 81 ounces of silver to buy an ounce of gold. That has been coming down. It was over 100, and now it's coming down to 81. And when it gets, it favors silver. So silver is more, if you're looking at which one is your best opportunity for a future increase, the experts say at this ratio, silver is a better value. It has gone down as low as, I think, in the 20s, but it's certainly down to the 30s, low 30s. But we're quite a ways from that. And those people who try to manage that or optimize that ratio, then they switch from one to the other. But if you do that, you have to pay attention to any slippage that might occur. At that point, down in the low 30s, many believe, probably true, that gold has a better opportunity for appreciation than silver. But at these prices, silver has a better opportunity based on historical numbers. A monster box of silver, generic silver, now costs $24,000, $24,710 as of Friday. That's higher as of right now. It may even be, probably is, over $25,000 as of right now. That includes a $1.50 per ounce markup for commission, and that brings it to $49.42 per round. Okay, if you have questions or comments, leave them in the comment section below. I always appreciate people who do, and sometimes if it looks like it needs a response, I will respond to them. But thank you for writing comments.